Today's panel on closing the financing gap is we're joined by 5 esteemed panelists with real breadth and depth of experience. I'll invite first to the stage Eric Annell, head of private debt from Sanlam. There's Charlie Robertson as well from FIH Partners. He's a brilliant macro strategist. We have Saad Sheikh from Enco Capital. He invests in largely hybrid and equity investments across the continent. Abdurrahman Abrams from Old Mutual Asset Management. He heads their alternative investment strategy. And we have Andy Bainbridge, from head of credit from Gateway Partners, focusing on private credit. So we hope you enjoy, and we look forward to your questions and answers towards the end.
Take your pick.
You just saw an example there of an economist who can't count. It's very, very reassuring.
So the theme of the panel is, it's a broad theme. What's the current state of the credit gap in the credit market in Africa? What have been, what are the broad ideas of what has succeeded in the market, from the perspective of our panelists. And then we'll also discuss and hear from the panelists what they believe strategies are to address the gap. And innovations aren't necessarily just technology related, but there are other forms and approaches to address the gap and help grow the economies across Africa. So just broadly speaking, I'll put a general question, to the panelists, and they'll take their turns answering briefly. What successes have been achieved? And we'll go from there. Charlie?
Well, I have done a lot of panels like this, and I ended up writing a book about it because it was frustrating to me to come and answer the same question so many times. And the answer is we can't close the gap. So the gap is GDP in Africa is 2.5 trillion, roughly. If this was China, it would be investing 40% of GDP. It's $1 trillion. We're actually investing about 15% of GDP, which is about $450 billion. There's about a $550 billion gap. Africa Development Bank reckons we've got 100 billion, or is it 120 now, billion dollar gap. They're not even close to how big the gap is. And Bridgewater Associates put out a piece, this is Ray Dalio's hedge fund, put out a piece a week or two ago. They said investments 15% of GDP, it needs to be 30% of GDP. That still gives us about $750 billion minus 450, so we're still talking a $300 billion gap. There is no way that this conference is going to fill somewhere between a $300 and $550 billion a year gap. And we cannot load Africa with that much debt, because with that much debt, you default. So we cannot close the gap. The gap closes by itself 20 to 40 years after you've educated particularly women. The fertility rate in a country falls. And then a country like China funds its own investment of 40% of GDP. Doesn't need foreign capital. Uses a bit, doesn't need it. India, same story, 10, 20 years later. Vietnam, Southeast Asia, they're all doing it right now. Educate people, 20, 40 years later, demographic decline, fertility rate falls, then you get the demographic dividend only after you've stopped having kids, and then your savings explode. Bangladesh has never issued a Eurobond, and yet half of you probably are wearing clothes made in Bangladesh today, because self-financed, because their fertility rate's below 2, they've got their own savings, there is no financing gap in Bangladesh, or indeed anywhere in Asia except Pakistan and Afghanistan. Why? Because they've got high fertility still. So no one can save money. You just can't do it. If you've got 4, 5, 6 kids to feed every night, you cannot save money. There is no money in the bank. You can't close the gap. So the simple answer is, and we can shut down the whole thing now, actually. It's done. We can't do it, but we will see countries go through that fertility decline. We've seen it in Mauritius 45 years ago. Why is Mauritius so successful? Why is this the second richest country on the continent, or around the continent? Because its fertility rate went below 3 in 1979. Morocco did it in 1999, which is why interest rates in Morocco are 2%, and there is no financing gap. And It's going to happen in Kenya in 2029. It's going to happen in Nigeria in the 2040s. And there's some countries that are going to wait until the 2050s. So for Nigeria, we're going to be asking this question for the next 15 years, I promise you. For Kenya, we can stop asking this question in about 5 years' time, which is going to get very, very exciting for them.
I'm definitely not following The Economist, so if anyone else wants to venture, I think he said it all, but way more elaborate than I would have. I also believe we cannot close the funding gap in our generation. What we can do, and what we've seen in really small bits and pieces, is everyone do their own little thing in their own country. That's kind of what's happening. So Sanlam is only focused on South Africa currently in the SME debt space, not across all the other countries as well. So I think from my own perspective, you can't close the gap if you don't even try. So we need more institutional money to flow into that sector. We need more support from government. I think that was actually one of the headlines of this session as well. What is governments doing? What are regulators doing? We need more of that. But I speak for myself on this panel. I'm not influential in that respect. So I'm going to side with Charlie that we won't see the closing of the funding gap soon.
Erica's a harder act to follow, so I'd swap seats. But you see, I think Imran, you asked, there are two embedded questions. One is closing the gap, but also what are the successes? I think the successes you see on the panel here. 5 years ago, if you were talking about a credit fund launching in Africa, the DFIs would kick you out of the room. They'd say, we're doing it, we don't need you. Very quickly, and there'll be DFIs in the room, I think we as credit funds add to the mix, we create diversity. One thing that I'd like to say about credit funds is everybody likes banks on the continent. They're very profitable, whether on the stock market or not, but inherent businesses are profitable if they're well run. As a credit fund, we take the profitable part of that business predominantly, right? Just the banking, no branches, no overheads, no costs. You take the banking aspect of a bank and you make it more flexible. You add bells and whistles to it that are more productive for businesses. And you've got a very strong opportunity to support the ecosystem, the business industry, but GDP in general. So I think the successes are, as we can demonstrate with us being here, it's been a hard toil. It's not been easy to try to raise a credit fund. It's been an educational process. What I would love to see is Africa attracting capital other than DFI money. And that's what I'm very focused on. When I speak to pension funds, when I speak to family offices, there is that intent. But guess what? We're sitting in a backdrop of private equity returns being subpar. So everybody's saying, oh, Africa is too risky. Africa is problem child. Guess what? If you de-risk it, if you do it well, de-risking does not mean you layer it with, bank guarantees, but it's about putting in the right and adaptable structures that are workable and that make sense. I think there's a huge opportunity. And yes, there's a huge gap, but that's why we're all here. We recognize that this gap cannot be filled by governments. This gap alone cannot be filled by DFIs. This gap cannot be filled by us, the private sector, alone. We all have to work together. But the way to work together is to mobilize all of these pools of capital and get them to work in tandem, not against each other. So I think that's where we are is a success. Where we need to go is work in tandem. While we won't close the gap unless we stop having kids.
As many. It's got to make sure you have two. Otherwise you end up like
two
China.
eat up all your savings. I can assure you two will eat up all your savings. So maybe half is the solution. So that's personal experience, by the way. So yeah, hopefully that's helpful, Imran.
No, very helpful. I think there's a diversity of views here, and there's no single lens. Abdurrahman, what's your take?
Yeah, no, there's definitely no single lens. I think having kids is good for you. I have 5 of my own, and obviously it's a big gap between 2 and 5. They do eat a lot. So consumerism is good for big families. I think there's, lots of comments here, bringing diverse views. there's another gap as well. And traditionally, you have senior debt and you have equity funding. And we fill a gap called hybrid, which just sits between senior and equity. And that's just another kind of subset of the gap that we need to fill. So there's a huge gap in terms of total funding needed in the continent, in South Africa as well. And I think we do need innovation. We do need new kind of sources of funding, and we need new funds to kind of go out and fill that gap as well. So from our side, we kind of fill the hybrid capital gap, and we've seen huge demand for this type of funding. And I think where you have traditional senior debt funding, you have traditional equity funding, you kind of, like boxed in, and borrowers out there can only source those kind of sources of capital. And they don't know that they can kind of fill that gap with some other sources as well. So the products that kind of innovate and present other options to borrowers, we need as well over and above kind of the traditional sources of credit and equity finance. Another point here is from our side, we've seen, and we success kind of embedded in your question as well, is funding kind of women-owned businesses. And we've seen a lot of traction in that space in South Africa as an example on the empowerment side. So there are kind of facets to how this gap needs to be filled. I think funding that kind of subset of a big gap in the market, we've seen success in that space, and I think we kind of need to fill that additional gap as well, because it's kind of a huge gap to fill.
Yeah.
But we need to actually start tackling each problem on it, kind of, and even in a small way, and that would make a huge difference over time. So I think kind of disagree with the economists. If we don't start kind of filling these gaps in a small way, we actually never get there. So yeah, that's my take on it.
Thank you. Andy, what's your view? You're gateway,
Yeah.
you do larger transactions typically.
It's a bit difficult because I kind of agree with every single one of the panelists who've gone so far. I get Charlie's point about the macro. I agree with that. I think Abdurrahman is absolutely right, though. You have to think about this not in terms of is the gap open or closed, but how do you help to close parts of it? How do you narrow the gap rather than close it? And I think you can do that, and I think a lot of that actually comes down to demonstration. It's something Saad and I are hopefully going to prove in the years to come. And yeah, I do larger financing. I'll come back to that in a second, but I want to talk about how demonstration works here in my mind. So about 22 years ago, there was a fund set up called the Emerging Africa Infrastructure Fund. And during its early stages, I was working for a big bank, and someone sent me the business plan for it, and I hadn't read it, and they said, "Where are you on this?" I said, "I haven't read it yet. What's the thesis?" And they said, "Well, we're going to do 15 to 20-year money in Africa." And I burst out laughing and said, "Don't be stupid. No one does 15 to 20-year money in Africa." And they said, "Read the plan." And I read the plan, and that was the Emerging Africa Infrastructure Fund, and we put 60 million into it, as did Standard Bank, although I'm not supposed to actually kind of talk up my competitors. And that fund is about 1.3 billion now. And the problem it has is that it competes with lots of other people because lots of people have worked out that you can make money out of doing 15 to 20-year financing in Africa if you do it well and you pick winners. Now, to Charlie's point, that won't close the gap, but it will enable successful business plans and people to raise the finance they need. And that's what we are doing at Gateway. So I think in another respect, financing has gone backwards since the financial crisis. So cross-border lending has gone down to some extent. And what's happened is the big banks, the multinationals, have sucked back to their core of financing multinational corporates. Local banks, which I think are a lot stronger than they were 10, 15, 20 years ago, are really good at financing some of the SMEs and getting businesses going. But we see a lot of middle market corporates now that struggle to get the term finance they need to expand and to create jobs. So I think that's the next opportunity where Saad and I, and hopefully our fellow panelists, will prove that demonstration effect will suck in more capital because it's profitable.
So we discussed, embedded in some, most of the answers, we talked, some challenges were mentioned, right? Fertility rates not going down, or, related to that, some public sector initiatives or lack thereof. What are, and it's open for anyone who wants to go first, like, in each of your opinions, what are some of the biggest challenges or hurdles to narrowing the gap?
I think I'll go.
You
Can
go.
I do? Okay. So Yeah, I think I've obviously over the last, 12 years thought extensively about that. What are the challenges? And I remember one of the first panels, and I'm always wary of who's in the audience because I know you all know this. I'm kind of preaching to the convicted already, but is it convicted?
Converted.
Converted, thank you, not the convicted.
You may have been
sorry.
right about it.
Might have been
Yeah,
convicted.
if I was in there, I might have been convicted. Yeah, I agree.
So the money isn't reaching the people that it's intending to. That's the biggest challenge, you know. So I agree with Abdullah. The females aren't getting the money. They're really the small businesses that really needs the capital to grow. They're not getting it. You know, the people that talks the biggest talk, that's got the money to come to conferences like this. You know, they're getting the money. They're up there. If you've got a great marketing executive, you're getting the money. But the person really making the impact on the ground, I don't see it reaching them. And I think the biggest challenge there for us is number one, to find them, you know, to find the right channels to access that pool of SMEs that is really on the ground, but not so much focused at raising capital and seeing, you know, your non-bank financial institutions like we are. You know, and the second thing, they're not educated in that way. They're entrepreneurs that have got a product and passionate about their product, but they're not so much educated in banking and finances. You know, so that if you talk about gap, I think that's a gap. You know, that your SME don't know of what is available out there to grow their business, and they can't access that. You know, and then we feel frustrated because we can't get to them. So I think, in my words, that's been a challenge. And then we end up lending to the mid-sized corporates. It's easier. They've got a CA or chartered accountant that does the accounts. They've got a marketing manager and an HR person. It's easier to lend to them. And from a governance perspective, everyone in our business is going, yay, they know what they're doing. But that's not really who we should be funding. So I think, yeah, that's a challenge.
So,
Andy?
okay, so my first point is, Erica, I agree with everything you're saying, apart from the fact that you say the mid-market firms have professionalized. They absolutely have not, in my experience, in sub-Saharan Africa. They have done a brilliant job at building businesses. But they really don't, quite often, they don't have necessarily the independent NEDs, they don't have the marketing person, they don't necessarily have the CA. Their external accountants may have a CA, but it's not guaranteed. So one of the things we're trying to do as well is, as we work with companies and lend to them, we've put a little proportion, it is a little proportion, but it's meaningful to me, of our management fees to one side for a TA facility to help these firms to professionalize. Because when they go to the DFIs, I'm very sorry for all of you who are DFIs in this room, take a very long time to tell people that they are quite deficient in certain respects. So what we're saying is, we'll work with you, we'll lend to you, we will try to help you professionalize, because that way, when you want to borrow money again, you can go to the DFIs, and DFIs will go, look, you've got a lovely shiny board, and you know what you're doing, we like your accounts, and it will help. So I think there's a big element here of we can help people to help themselves. And let's be clear, we're financiers, we make a good return out of it, as Saad says, but we can help to make it closer to closing the gap.
Agreed.
Charlie, you seem
Well,
to be reflecting.
Yeah, because also there's a positive, something positive the authorities can do. So the negative is FX policy. You get FX policy wrong, and you make your situation worse. So what we know is, if you've got a high fertility rate, you've got a small banking system. That's true of every single country in the world. So if you've got a small banking system, what is the cost of borrowing? If you run a current account deficit, it's the highest in the world. 3% real rates on average in high fertility countries, which all have small banking systems, if they run a current account deficit. So you've got a small amount of savings, and it's literally going out of the door on that current account deficit all the time. And then you run out of savings, and then you default or devalue, and then you get massive spikes in inflation, and then everyone looks at your country and says, this is a very volatile place, I'm not putting money there. You're into a very, very negative cycle. So the unfairness of this is that the poorest countries in the world pay the highest interest rates in the world because they've got no savings, right? But that's not always true. If you run a current account surplus and you've got a small banking system, that same high fertility rate, small banking system, but current account surplus, you pay 0% real rates. That's the same as a rich country. That's the same as China. So your real cost of borrowing falls to rich country levels. It's unbelievable. So what we need to see is governments stopping running 50% overvalued currencies, which, by the way, was Egypt 2 years ago, Nigeria 2 years ago, Ethiopia 1 year ago, and say, we're going to do everything we bloody can to get our current account in a better position. Because if we do, instead of our money going out of the country all the time, we're actually going to be attracting money into the country through our current account surplus, or at least keep it balanced so you're maximizing your investments. And that's actually what's happened in the last 2 years. It's phenomenal. Egypt today has got a 30% cheap currency to its own 25-year average. You have never had the chance to put money into Egypt at such a good exchange rate, except for twice in the last 25 years. And there's one country that's even better than that today, which is Nigeria. That is not just the cheapest currency in Africa, it's the cheapest currency in the world of the 80 countries I look at. The only country that was close to as cheap was Japan. On the 5th of August, the yen suddenly appreciated massively, nearly caused a financial meltdown globally. The Nigerian currency is as cheap as the yen was then, but it's offering you 25-30% interest rates. My God, it's amazing. So we've actually got governments, and Ethiopia's done exactly this. Well, they've taken their currency to fair value from 50% overvalued. Brilliant, brilliant. This is exactly what we want to see happen. So governments have got it in the last 12 months. Now, you might argue it's because the Fed forced them to get it because they hiked rates to 5.5, and what choice is that? True, true, true. That's all true. But we are nonetheless in a much better position today than we have been for years and years and years, as well as having the best educated African population we've ever had, as of today. So this is, it's getting good at the grassroots, and it's getting good in terms of macro policy as well, for some of the biggest economies. It's great news.
It was very different, insightful thoughts over there, and interesting investment ideas. So,
if you want to close out the challenges, I'm happy to just close it out. The one thing that I will say, and I think Andrew's mentioned it quite well, at the company level, it's about education, right? The technical assistance, the way that they do it is slightly different to the way that we do it, but we also do technical assistance, although our partners will provide that capital. But one thing I think that the challenge that we're trying to solve for, and we're hoping at Enco Capital, that's what we're doing. We're demonstrating to investors that Africa can return extremely well in terms of cash flows to investors. So Enco's hedge fund has got a 8-year track record, and my CEO sitting in here is going to kill me, but I'll get the numbers wrong, but we've probably given about 15% dollar returns. What that's done is it's attracted US, European pension groups to come in. I think it's a passion of mine to demonstrate that Africa is not as or more risky than anything that you've invested in Southern America or South America or the Far East. It's the same risk, it's just a perception. And you de-risk that perception by showing great value coming out than just showing zero negative returns and quoting that in impact. I really have a pet peeve of, if you want to create impact, you don't want to give returns. I think both can happen at the same time. And that's what we demonstrate at Enco's, at least the credit fund. I know Andrew and a lot of the panelists are trying to do that. So pet peeve of mine is to demonstrate that Africa is not any exorbitant risk that you've put in your head. It's just badly invested into. So that's what I'm trying to solve for in what we're trying to do at in the private credit, but broadly at Enco Capital.
Thanks for that, Saad. Abdurrahman, to move on to the next question, if you don't mind sharing from your view, what are some of the innovations, if not innovative approaches, you would take in helping address the gap that's never going to go away,
Yes.
right? Or hopefully may.
So I think when I touched on this in the introduction from our side, we think this product as hybrid capital is a big game changer in the sense of filling the gap that wasn't really necessarily filled in the past. And I think you've seen this trend across the globe where guys have been able to provide a piece of capital that just needs to kind of fulfill a transaction and make it kind of take it over the line at the end of the day. So I think you need to be innovative around the instruments and the kind of products that you offer. And the example being the hybrid instrument, we've seen kind of anecdotally in some of the transactions we've done, guys were about to walk away from the deal, and they needed this small piece of capital to make it work. So there are pieces of capital kind of ready to invest in the senior debt, ready to invest in the equity, but they need to plug one gap as opposed to the entire funding gap. And you were able to provide a solution where maybe the borrower themselves didn't know that they have this product available to them. So you need to sit down, structure a bespoke instrument, and then fund in that gap that exists in a specific deal, in a specific sector, in the types of indices and kind of companies that we look at. We've seen this over and over. So I think you can kind of come up with innovation around funding products, and you are able to then return kind of commercial returns to investors at the end of the day. So I mean, I tend to agree with Saad in that you must demonstrate track record. I mean, in kind of the old mutual business, and especially the hybrid and kind of debt businesses that we've done over many years, delivered significant returns, maybe for 20 plus years already. And even in the fund that we look at, and we've seen this kind of track record play out multiple years with kind of a very good outcome for investors. And they are able to get that kind of demonstrated returns. So I think coming up with solutions, coming up with innovation and product is useful for the entire kind of credit market and filling the necessary gaps that we have at the moment. That's kind of, from my side, I think we can definitely do that.
A typical woman, I always have something more to add. Sorry about that, so stop me. I want to add to what Abdu is saying. Innovation in the product is key. Because the businesses at grassroots, they're not going to change. They're going to sell the same thing, and they're going to do the same thing, and the SME economy is going to stay the same. So we need to come up with better solutions. So I can't coin this, and I'll definitely give credit to Julia. Julia's usually here, Julia Price, and she's got her own business in South Africa, and we've started working with them, and they call it pay as you grow. And I think that is probably one of the best solutions that I've seen for an SME business. So it's literally, it is what it says. You don't have to have a fixed term of repayment, neither a fixed term or a fixed interest rate. You pay as you grow. So they take a percentage of the cash flows on a monthly basis. There's various permutations of that. It's like merchant cash advances. That's kind of the other term for it. But that's really, it blew my mind the first time I thought this is what we should be doing. A small SME, and that's how we disintermediate the banks. And sorry for the banks that are sitting here, but you're very strict on this is the interest, this is the capital you amortize from day one. SME can't afford that. So you've got to be flexible in terms, and if you can walk with them, and collect as they grow, I think that's brilliant. Yeah.
Thanks. Andy, you innovated, you told us about EIF earlier. That was an innovation.
Yeah.
What do you see from that experience? What do you think should be a next innovation?
Well, I'm probably too stupid to give you the details, but the thing that strikes me that we all probably agree on is transparency. So demonstration and transparency. So I love the fact that you've got the GEMS database now reporting on people losing money or not losing money in infrastructure in emerging markets, because that kind of validates the whole emerging Africa piece. I love the fact that when Saad and I compete for our next fund, and we'll do it collaboratively, we will be going out to people and saying, you can make these returns in Africa, and you can help firms to grow, and they create jobs, and it does good, so you make money and you feel good about yourself. And that demonstration, that transparency, will bring more capital in. So I say to my team every now and then when they say, oh, this deal will make so many jobs, I say, well, look, unless we get our money back, unless we make a return for our investors, the impact of what you do is nil. Because actually what you have to do is you have to persuade all the people out there on the sidelines to come in and say, actually, yeah, this is a good business proposition. So anything that increases transparency, to my mind, is a really good thing. So credit bureaus are good things. Any form of aggregated reporting by sector or by segment is a good thing. And I think I'll leave it there.
It ties into what Erica mentioned also about identifying people, right?
Yeah.
Well, if I could just add in, and there's going to be some brilliant businesses. So
yeah.
Europe has been through exactly what Africa's at now. So Europe in the 19th century was relatively well educated, not that well educated actually, but enough, but with a high fertility rate. So what did it have? It had no savings. So what happened? You've got no savings, you've got too many people, massive emigration. America, South Africa, Argentina, Australia got populated by these Europeans. And of course, we're seeing that in Africa today. We're seeing people from Nigeria go off to Canada, the Japa thing. We're seeing Ugandans in Dubai. It's happening everywhere. But the people who are left behind are then building businesses. But they haven't got easy access to cash because there just isn't much. And in Europe, in Britain, companies like Sainsbury's started in the 19th century, and Lloyd's, and Boots, sorry, the chemists. These all started family businesses, much like what Dangote is doing, and that family business succeeded and grew, but very slowly. Britain had the slowest industrial revolution the world has ever seen because we didn't have any money, because we were having too many kids. This is my great-great-grandparents' fault. And that is a problem, but there are still going to be gems, and you guys are going to bring in capital and speed up those gems, grow them a bit faster, because there wasn't anybody else in the rest of the world who had savings to give to Britain in the 19th century. So the rest of the world does now have some savings, and it can allocate it more profitably in Africa, I would argue, than in many other places, like Chinese property, for say. Not such a good... Anyway, so there's going to be some... So keep going. What you're doing is great stuff.
So we've there's a lot of onus, if not burden, on the private sector and asset managers and economists to help guide everyone. But the next question to the panel is, what should the public sector do? The authorities, the regulators, the administrative authorities across, depending on what sector they're focused on. What kind of support do you feel they should provide the investors to help address the gap, whether it's to help deploy or even to attract capital as you raise funds?
I'd love to go for that one. And I'm facing this issue, for example, in a francophone West African country. Let me not name it. Trying to get them, or encouraging African capital for African business is probably the toughest thing you can do on the African continent. You can go and run a business, you can turn around a business and still be left standing, but once you deal with an African pension fund, you can't stand on your 2 feet. It's such hard work. Trying to encourage them to deploy for Africa, there's so many hurdles that they throw in front of their own self. They're almost kind of trying to create hurdles for themselves to prevent development in Africa, which is mind-boggling. So capital controls. Now, capital controls prevent countries, and South Africa did that phenomenally well. They took the capital control situation out of the way. They said we can deploy 45% of our capital available in the country to ex-South Africa businesses. And now you see the PICs, the EPPF, et cetera, doing very well, diversified investors. But this West African Francophone pension fund cannot kind of remove these capital controls because the government, the Treasury has put them in place. As a consequence, we, the private sector, if we require their capital, we need to create alternative structures for them. So the capital sits in that country. We can then create either swap structures or feeder funds or whatever to actually use that capital for growth. The public sector, the pension sector, the governments, the ministries, they need to really get out of the way of themselves. They really need to think outside the box, do what, Nigeria is the biggest example of not doing this. So much capital sloshing around, and 80-90% of that capital is going and buying T-bills. No wonder the yield, when it goes up on treasury paper, everybody's plowing into it. Oh, it's 26%. Oh, it's 30%. All of these pension funds are going. Who's actually building the economy? No one. And that's where I think there's a shift required. Now, I don't know if it's our generation. I don't know who's going to create that. But that's what we're trying to do, educate these folks, these pension funds, and say, loosen the reins. You can, with diversification, you'll get better returns, not worse. So I think that is what the public sector can really help with, that excess liquidity sitting in local currencies is not getting deployed. And that needs to get deployed to effective businesses and real businesses that'll generate GDP, not just government paper that'll go into lining people's pockets.
Can I just give an example of that as well? So I absolutely agree with what Saad's saying. So in Nigeria, for example, there used to be a regulation that said for pension funds they had to invest in AAA-rated instruments locally. Now, there was only one AAA-rated instrument, and no one gets fired for investing in government bonds. So working with NSIA, the Sovereign Wealth Authority there, and PIDGE, an institution I used to be associated with, we helped create InfraCredit,
Yes.
which is a local guarantee institution. It is AAA rated in Nigeria, which enable pension funds to invest into infrastructure in Nigeria, so putting money to use in their own countries as well. So that's an example of what governments can do. They can help to clarify and explain and remove excess regulation.
Andrew, just add,
Sorry,
I think
bad, not excess. I apologize.
yeah, but this should have been one of the successes. What we've done really well, what you guys did at PIDGE in order to create InfraCredit, phenomenal. I mean, I've knocked on Chinua's door so many times to give me a guarantee, but he'll only give it in local currency. So, but it's a solution, and that's what we need to create. So, yeah, fantastic win there.
Do we have an economist's view?
No, I think I answered it on the FX side.
Yeah.
All I'd add is you just don't mess up fiscally. If you start printing money, the consequence of that is you destroy what little savings, and there aren't very many, so they're damn precious, they get wiped out. Now, Zimbabwe's done that most famously on the continent, of course, but the whole of Latin America did it in the 1970s and 80s, when they were high fertility. So governments sit there saying, oh, we've got no savings because the fertility rate's high. Therefore, what do? We borrow lots from the American. We default on it. They did that. That was the 1980s. And then you go and print money because how do we get through the budget this year? And you wipe out savings. It's taken Brazil 30 years to rebuild its savings since the wipeout of the 1980s. So as long as governments don't absolutely screw up like that, this is why the Francophone countries do all right. They've got... all right. I'll stop there. Just don't mess up the fiscal too badly.
Good timing.
That's fine.
We've covered the major themes and the topics that we planned on discussing. I think in the interest of time, and I'd like to open up the floor to the audience with any questions for our esteemed panelists. Anyone? No?
Covered it all.
Oh, thank goodness.
There you go, ma'am.
I'm interested in what you were going to say about the Francophone countries and what they are doing right.
Two things. Firstly, the fiscal side is quite small budget deficits. So and they do that to stay within this currency peg with the French. But the second thing is that currency peg.
Yes.
And at a local level, there's all sorts of problems with that. And the Senegalese president, when he was coming to power early this year, kind of the hint was he was going to abandon the peg, which would be a catastrophe. Because the French, the peg is much like the gold standard. So the reason Europe had no savings in the 19th century because of the high fertility rate, but we did have low interest rates, relatively low interest rates. And that's what you've got in Senegal. So actually you've got a fair amount of electricity in Senegal and Cote d'Ivoire. Enough actually to power manufacturing. They haven't got the literacy, sadly. That's where they've not succeeded yet, but they have got the electricity, and that's because these long-term interest rates are low enough. So although there's not many savings, the savings that are lent out are at low interest rates. So it works. It doesn't solve the volume of savings problem, but it at least means that the investments you do, you probably get paid back on. So that's what they get right as well. So it's controversial on the ground in Abidjan or Dakar, but it's
Thank
helpful.
you.
Another question? Anyone else? In the back?
Great.
I think someone said, what's the name of Charlie's book? It's the time...
I heard it.
Did I? It's The Time-Traveling Economist, and it's very expensive in English, but I just did a French version, badly translated by software, but anyway, €4. So to sell to people who need to read it. Time-Traveling Economist, or something else in French, I can't remember. Anyway, there you
You
go.
might want to keep that name handy, huh?
The French
Next time,
one, yeah,
the
it
French
would be
one.
helpful. It's, I literally can't remember. I'm going to sort it out on a card.
No worries.
All right. I guess if no further questions, then I'd like to thank the audience as well as the panelists for all these views. Great.
Thank you. Thanks, everyone.